Welcome to the Deep Dive. We unpack complex ideas to reveal their simple, powerful truths. Today, we're taking a magnifying glass to something really quite remarkable. A 2006 shareholder letter from the Markel Group. You know, an insurance giant often called a mini-Berkshire Hathaway. Now, just imagine a company reporting a year where net income more than doubled to a record $393 million. Their combined ratio improved dramatically to, well, a fantastic 87%, and book value per share soared by an amazing 32% to $230. Sound like a dream year, right?
It absolutely does.
Uh,
But what's truly striking, I think, is their immediate transparency. They openly admitted to, quote, a large dose of good luck because it was a benign weather year.
Right.
This isn't a company just, basking in fortune. They were quick to say that good weather does not deserve all the credit. They attribute the real credit to their associates' combined energies. And that immediately signals there's a deeper, more intentional strategy at play here than simply, riding a wave.
Yeah, that's a crucial distinction they make. And well, that's our mission today. We're diving into this letter to uncover the blueprint for what Markel really credits their enduring success to these foundational principles that made them, in their words, an incredibly strong company that keeps getting better. We're going beyond the impressive numbers to understand the core philosophy, the thing that drives long-term sustainable success. You'll discover three interconnected principles that underpin pretty much everything they do, maintaining a long-term time horizon, unwavering discipline, and a culture of continuous learning. All right, let's unpack these insights because what Markel has done here, well, it offers some powerful lessons for any business leader or investor, I think. So we've set the scene with those incredible 2006 results and Markel's kind of surprising acknowledgement of good luck. But as you just noted, what really stands out is how quickly they pivoted from those headline numbers to emphasize the deeper strategy at play. It's almost like they're saying, hey, don't be distracted by the shiny object. Look at what's underneath.
Precisely. And that level of intellectual honesty is pretty rare and vital. By explicitly stating the role of good luck from the weather, they redirect attention to their underlying strengths and the principles they really champion.
Yeah.
This immediately sets the stage. It tells you their sustained success isn't just circumstantial. It's a result of fundamental, well-applied strategies by their team. They were, you could say, prepared to be lucky.
And that preparation is key.
Exactly. Preparation is truly key.
That preparation is everything. They weren't just lucky, they leveraged that luck into exceptional results because of their foundational principles. So let's dive into those, starting with maybe the most counterintuitive one in a world that often demands, short-term wins,
Yeah.
the long-term time horizon. This next point, it really highlights the power of their long-term perspective. Markel argues that, yeah, luck influences short-term results, but sound business principles and skilled application only really become evident over longer time horizons. So how did this actually play out over their first 20 years as a public company, say from 1986 to 2006?
Well, zooming out a bit, you see why this long-term view is absolutely critical. Over those 2 decades, their investment portfolio just exploded. It grew from, a modest $31 million to a staggering $7.5 billion. Yeah. And shareholders' equity that started at $15 million, or like 3.42 cents per share, which is basically the company's net assets per share. A key indicator of underlying value, it ballooned to $2.3 billion, or about $230 per share.
Incredible numbers.
Yeah, they're not just big numbers. Yeah. They represent compound annual growth rates of 32% for investments and 23% for shareholders' equity. This isn't luck playing out over a few months. It's, the undeniable result of consistent long-term application of their principles.
It's clear their investment strategy hinges on patience, but how does this long-term perspective translate into their operational decisions? I mean, the day-to-day pressures of the insurance business must be immense. For example, they highlight how impossible it was back in '86 to forecast things like the S&L crisis, the rise of the internet, huge energy price swings, or 9/11.
That's a great point, and it reveals, I think, a profound trust in process over prediction. Their approach meant, and they said this, they didn't forecast them and we didn't need to. They simply took the capital they had and used it effectively in insurance and investments, just following sound disciplines. Another really powerful example is the Terra Nova Group acquisition back in 2000. Apparently, it was a painful exercise for Markel's associates and shareholders in the short term because of, inherited issues.
Right. Integrating acquisitions is always tough.
Exactly. But by sticking to their discipline and instilling what they call the Markel style, Markel International actually started reporting underwriting profits by 2006. That decision required immense fortitude, to endure that short-term pain for the long-term vision.
That's a huge lesson right there. Sometimes seemingly bad short-term results are actually part of a long-term winning strategy if the underlying discipline is solid. And it wasn't just about fixing things, right? Before that horrible 2005 hurricane season, Katrina, Rita, Wilma, they'd already strategically diversified their offshore energy business.
Yes, and while they acknowledged this had an element of luck, they clarified that luck can sometimes be confused with doing the right things over and over again.
Hmm.
This long-term strategic move significantly cut their losses relative to the market and actually put them in a position to expand those products later. It wasn't reactive, it was proactive, patient.
Okay.
They also showed this patience when opening 5 new international branch offices in 2005, places like Bristol, Edinburgh, Madrid, acknowledging it would be some time before they have a major impact on results.
Yeah.
They're really thinking decades ahead, not just quarters.
And you see that same patience maybe combined with a bit of contrarian thinking in their approach to private equity. Back in 2006, they described PE and hedge funds as white hot.
Right.
But they anticipated investor disenchantment because of high fees and short-term focus.
Yeah, it's compelling to see their measured approach there. Instead of chasing the hype, they focused on direct deals with principals, targeting management teams with a, quote, long-term return on capital focus.
Yeah.
They were basically preparing for opportunities to develop over the next several years, positioning themselves for when others might be selling, not buying. This shows a deep understanding of market cycles and, frankly, human psychology resisting that urge to follow the crowd.
So how does this apply to you listening? This isn't just about waiting around. It's about intentional patience. It's making moves today that might not pay off for years, maybe even decades, and having the fortitude to see them through. It's a powerful mindset that counters our instinct for, immediate gratification and short-term thinking. A mindset I think many of us struggle to cultivate.
Okay, building on that long-term view, Markel emphasizes discipline as what truly distinguishes them. It seems woven into every decision, and it's clearly not easy to maintain, especially when markets are volatile or trends seem to shift constantly.
Indeed. And this raises an important question. How do you actually instill and maintain such profound discipline across a whole organization, especially over long periods? The letter notes that about a quarter of their, 1,897 associates in 2006 had been with them for over 10 years.
Wow, that's significant tenure.
It really is. These veterans had seen both bull and bear markets, they'd learned from successes and failures, and crucially, they'd embraced the Markel style. It's a testament to a deeply embedded culture that fosters this discipline and, importantly, passes it on to newer team members.
That continuity must really help solidify the culture. So let's talk about that underwriting discipline in action. Their philosophy sounds clear. To achieve consistent underwriting profits in all products and all insurance market conditions. And the process involves asking these fundamental questions. Can we assess the risk? Can we design the coverage? Can we price it for profit? Can we assess future trends?
It's a rigorous approach, almost scientific. A really excellent example they give is the casualty product at Essex Insurance Company, one of their first units. For 26 years, it achieved 10 or more points of underwriting margin. That's outstanding, meaning they were consistently profitable on every dollar of premium they took in.
What was the key?
Well, the key was this. Every single policy issued by their agents is re-underwritten and repriced by an Essex underwriter before final approval.
A second check.
Exactly. This second set of eyes, this extra step of discipline, they say, is directly responsible for a big chunk of their profits. And this isn't just a process detail. It reveals, I think, a profound insight into organizational psychology. Many companies would shy away from this extra step because it seems inefficient, or there's pressure to chase volume.
Right, get the business in the door.
But Markel understands that true discipline means prioritizing the integrity of each decision over those short-term metrics. That's a lesson most businesses really struggle to embrace.
That's incredible. It sounds like they're not afraid to put in the extra work, even if it slows things down a bit. And sometimes discipline means walking away from business, which, wow, that must be incredibly hard when you're focused on growth.
Absolutely. They demonstrated this back in the late 1980s. When the market conditions softened for a product's liability business, rates got depressed, their discipline actually required them to walk away from premium volume.
Really? How much?
It fell from $50 million down to under $10 million,
Yeah.
and they redeployed their underwriters.
That's a monumental decision for any company, just consciously sacrificing revenue like that.
Huge. But then, when the market hardened after 2001, Shand, their unit, was ready. They had the expertise, the people were still there, basically. Premium volume grew significantly, and they generated profit margins through the consistent application of their underwriting discipline. They sacrifice short-term revenue for long-term profitability. Hard choice, but ultimately a smart one.
That same discipline, it seems, applies to their investment strategy, and that's where so many companies can get swayed by fads or, emotions. Markel has this four-part equity investment philosophy, almost like their North Star. Profitable businesses, honest and talented management, reinvestment opportunities, and capital discipline, and all at fair prices.
Yeah, and the striking element here is how they address human nature directly. They acknowledge the psychological pain of underperformance, which causes many investors, amateur and professional alike, to sort of lose your moorings and drift into different styles.
Chasing returns.
Exactly. But Markle believes drifting away from it is a big mistake because human nature seeks comfort in crowds rather than the relative isolation of remaining independent.
Right.
Sticking to their North Star lets them remain steadfast even when it feels uncomfortable. That's a true testament to their commitment.
And this disciplined buy and hold strategy isn't just about conviction. You mentioned it creates excellent tax efficiency. They reported, $712 million in unrealized gains and a $249 million deferred tax bill as of 2006.
Yeah, and what's truly insightful here is how often investors, even the pros, kind of work against their own interest. By resisting the urge to just do something, trade and realize gains, they're letting capital compound tax-free for much longer.
The power of doing nothing.
It's the silent, often overlooked power of inaction. It's a discipline that directly fuels wealth creation, yet it goes against our innate desire for constant activity. If they were to sell off securities just based on forecasts, well, they'd have $249 million less to invest. That's less capital working for them.
That's a powerful framework. It allows for rational decisions, even amidst chaos. But even with the strongest discipline, mistakes happen, and Markel readily admits that. Which brings us nicely to their third core principle, this culture of continuous learning. So let's explore how even expensive lessons become, growth opportunities for them.
Yeah, a key takeaway here is how they integrate learning right into their core operations. Continuous learning is, as they say, critical to an organization such as Markel that underwrites and markets complex specialty products. And as they candidly admit, sometimes these lessons can be very expensive.
Very expensive indeed. Like the 2005 hurricanes, Katrina, Rita, Wilma, those storms resulted in $301 million in underwriting losses by the end of 2006. That's a massive hit to absorb.
It was huge. But this expensive lesson led to concrete, systematic actions. They formed a central catastrophe exposure management team, developed new tools, set insured value limits in catastrophe-prone areas, increased pricing, refined coverage terms, and geographically spread their catastrophe-exposed business to reduce their reliance on reinsurance.
So they really analyzed it and acted.
Definitely. And they acknowledged it's an iterative process, recognizing that learning is ongoing. It's not a one-time fix. They didn't just endure the loss. They actively used it to become stronger.
That's a fantastic example of learning from, painful failures. But do they also leverage their existing strengths or specialized expertise as a form of continuous learning?
Absolutely. Their environmental products division is a prime example. It boasts senior associates who have previous training as environmental consultants and engineers.
Oh, interesting.
Yeah, that added level of expertise lets them better evaluate environmental assessments, environmental inspections, and risks in general. It boosts their credibility and has been instrumental in building a successful niche business. It shows how deep, specialized knowledge fostered by continuous learning becomes a real competitive advantage.
And one of the most powerful learning tools they emphasize is just listening. Underwriters spend up to 20% of their time on the road visiting and working with our clients in their offices. They believe nothing replaces eyeball-to-eyeball contact.
It's compelling to see how this translates into actual value. Through this active listening, they identified unique client needs and created these value-added services that really set them apart. For their camp and youth recreational business, for example, they offer a 24-hour emergency response service providing grief counselors, PR advice, expert defense protection, services seldom provided by our competitors.
That's going the extra mile.
Totally. And in excess and surplus lines, many policy forms are manuscripted or tailored to fit individual insured's needs. This showcases true problem solving based directly on listening to their clients, not just selling them off-the-shelf products.
That personalized approach seems like a direct result of their commitment to understanding their customers. And their learning culture extends to their investment philosophy too, right? Contrasting foresight with actual practice.
Yes, they cite the investor Bill Miller, who noted that a value-based, individual security-oriented discipline offers better skills and results with longer practice than an investment approach based just on forecasting of events or circumstances.
The old forecasting problem.
Right. As Peter Lynch famously joked, if any economist could predict interest rates correctly twice in a row, they wouldn't need a job. Markel argues that forecasting is not an activity in which one can learn from mistakes, unlike their disciplines, which allow for continuous improvement through feedback.
So when an underwriting or investment decision doesn't work out, they don't just move on. They do a rigorous post-mortem analysis.
Exactly. They ask why. Did we misunderstand the risk? Was the management ineffective? Was the price just too high? This intellectually honest questioning creates a learning environment that increases their skills and judgment for future opportunities. It's about constantly evaluating and refining their process, essentially, watering the flowers and pulling the weeds in their operational garden.
This really ties everything together, doesn't it? Learning is what allows discipline to evolve, and that long-term view provides the space for that learning to actually compound. It's about constantly identifying what works and improving what doesn't, making them stronger over time. So how do all these principles, the long-term thinking, the discipline, the continuous learning, how do they translate into actual business growth and a strong financial position for Markel?
Well, bringing this back to the overarching theme, it creates what they call a virtuous cycle, where success breeds success. Their model for profit is crystal clear. Consistent underwriting profits, superior investment returns, and managing our capital create growth in book value per share for our shareholders. And they explicitly warn against the great and common danger of seeking premium growth at the expense of underwriting profits. That, they say, always leads to disaster in the long run.
A common trap.
A very tempting trap for many companies. They are deeply committed to profitable growth, not just growth for growth's sake.
And they've demonstrated this strategic growth through both organic expansion and smart acquisitions, right? Even doubling their size twice in 1990 and 2000.
Yeah, in both of those cases, and in other smaller deals too, they specifically purchased companies in need of repair. This required reorganization and really instilling the Markel culture to achieve that profitable growth. Their approach is to see growth potential in things like innovation, creativity, customer service, and problem solving as niche underwriters, focusing on areas where they can truly add value and solve complex problems for their clients.
Another critical element of their financial strength seems to be their loss reserve philosophy, this deep commitment to a margin of safety.
Yes, absolutely critical in insurance. They maintain a philosophy of establishing loss reserves, which totaled, $4.3 billion back in 2006? And 60% of that was for IBNR incurred but not reported claims.
Claims they know happen but haven't been reported yet, or maybe haven't even fully developed yet.
Exactly. This is crucial because in insurance, some liabilities, like asbestos claims maybe, can take years, even decades to fully materialize. So reserving conservatively for these unknown future costs is really a hallmark of financial integrity. They aim for reserves that are more likely to be redundant than deficient. This conservative approach acknowledges that, surprises are almost always bad in insurance. It's a profound commitment to long-term financial integrity. They explicitly state that consistent application of our reserving philosophy is more important to us than reported earnings. That's incredibly powerful in an industry often pressured by short-term results.
That's a strong statement. Prioritizing philosophy over what might make the quarterly numbers look better. And this conservatism has clearly paid off. They cite an example with their specialty physicians product, where cautious estimates led to about $75 million in reserve redundancies being released in later years.
Right. It highlights how their deliberate, conservative choices create financial flexibility and strength over time. And this long-term thinking is also directly tied into their incentive compensation system. Management bonuses are tied to lofty goals, like underwriting profits or growth in book value. Senior execs get part of their bonuses in restricted stock.
And they even encourage all associates to buy Markel stock. That clearly aligns employee interests with long-term shareholder value, reinforcing that virtuous cycle they aim to create. It really does seem like an integrated cultural approach that values intellectual honesty, patience, and just a relentless pursuit of improvement, making sure everyone is rowing in the same direction towards long-term success. So what have we really learned today from Markel's 2006 letter? It seems pretty clear that extraordinary financial results are rarely just about luck. They're often the byproduct of these foundational principles. A tenacious, long-term time horizon that allows skill to actually emerge, an unyielding discipline that guides every decision, and a culture of continuous learning that turns challenges into growth opportunities.
Exactly. And these aren't just corporate maxims. There are powerful frameworks for your own life, your career, or your investments. They show that resisting the immediate, sticking to a well-considered plan even when it's uncomfortable, and always seeking to understand why, especially when things go wrong well, that can lead to compounding success far beyond what you might imagine. It's about building something durable, something truly resilient.
So consider this. What aspect of your personal or professional life would truly transform if you committed to, say, a 20-year time horizon for your goals? If you applied an unshakable discipline even when it's really hard and made continuous learning your highest priority, what could you achieve by deliberately cultivating your own virtuous cycle through these, well, timeless principles?
This deep dive into Markel's blueprint really gives you a powerful lens, I think, to view not just financial markets, but the enduring principles of building anything of lasting value.
Keep learning, keep digging, and we'll catch you on the next Deep Dive.